Hey everybody, good morning. Welcome to Stock Trading Pro. Today's episode is going to be packed. We have a lot to cover this week. This is going to be a volatile week, and we're actually going to start talking about the bank earnings later in the week. But first, we want to break down a little bit of sector rotation. I want to start today's video out with giving you some of the ways that order flow is now rotating out of technology, and it's pretty obvious right now, and into two other sectors. One of them has exploded over the last 4 weeks, actually, after going down for roughly about 12, 14 weeks. And the other one was still waiting. And I want to really give a big lesson today on a big part of what we do, which is the New York method, which is stacking the order flow. And I don't know that we have a better example in the energy sector today to give you. Plus, we're going to tie that back into a swing trade that I'm looking to start this week with pretty good profit potential. And I think you're going to like that setup as well. The swing trade that we're going to talk about today has a pretty clean setup, but it's only got 1 day of stacked order flow. So there's a ton of stuff for us to unpack in there. And based on how long I've been trading, and actually, ironically, it's just kind of interesting. 1 week from today is my anniversary of when I first became a professional trader, which was in April 17th of 2000. My God, it feels like a million years ago. But this is really the biggest thing. Once you understand order flow and the trade expectation, which is the expectation that your profit target will be hit versus your stop loss, that's all about setting up an edge. Too many people just look for the setup or whether or not it hit the scan and popped it into the list because it hit a scan. I want to remind you of something that's really important. Just because a stock meets the scan criteria doesn't mean that it's a good trade for that moment. That is really, really important to understand. And I'm going to break that down for you today in the swing trade in the energy sector that we're going to talk about. There's a whole lesson in there, and I'm really excited to share that with you. Of course, it's Monday. We're also going to give you the daily ticker newsletter for today. You can actually grab that copy and download that in the description below the video. I can't wait to get started. We have a lot to talk about today. I'm getting a little bit ahead of myself. Good morning, Andrew and Gardner. How's it going? And of course, my buddy, John Bates. Good morning. So stick around. Be back in just 1 second. Okay, so I think what we're going to do is we're actually going to go straight into the big story for the week, which is obviously earnings. So we've actually kind of fast forwarded all the way into Friday, and this is something that really needs to be discussed. And I think really probably the biggest thing to talk about here with the banks, there's not a question of whether or not there's volatility, right? We're specifically right now talking about the large cap banks. We're talking about earnings. Let's actually pull that up on the list again. So you can see we actually have JP Morgan, we have Wells Fargo, and we have Citigroup, and to a little bit lesser degree, obviously PNC. Now, the interesting one here is FRC, First Republic, because that's the company that had probably one of the biggest implosions after the other one. You can actually see where it was. Now, we get a lot of questions from people about whether or not, because the stock was 147 and change and now it's 14, it's too low or it's gone too far down. It can't go much lower. Therefore, it's a good trade. We really need to break down what it means to put on a good trade. And again, we have all the trading books. Everybody, I'm sure, has read Reminiscences of a Stock Operator. He's very, very famous in that book for saying it's never too high and it's never too low. That's just talking about the price of the stock at that current moment. That has nothing to do with whether or not there's a high probability it's going to move in your favor. And we have this kind of heated conversation often about buying or selling at a stop loss, or excuse me, buying or selling at support. Now, we all know that buying at support, especially if it's a major support where buyers kept coming in there and holding that price, you could probably manage your risk pretty well if it's a major support level. However, the reason we are putting on a trade is because there's a higher trade expectation that it's going to reach our profit target. So I just want you to really think about this, because this can make the difference between being a break-even trader and getting to the other side where you're consciously developing the habit of taking trades because there's a good probability of them moving in your direction versus just the fact that you feel good about managing the downside. So I just want to recap that because it's really important and it applies to a lot of these bank stocks right now. Just managing the downside, while that's important, is different from managing the downside and having a probable move in your favor. Very, very big difference. So if we kind of tie that back to some of these bank stocks, which obviously FRC and Silicon Valley obviously is the one that kind of led the entire thing. We're hearing a lot of stories right now about, is the banking contagion contained, for lack of a better way of putting it, the financial contagion, specifically it was in these regional banks, right? A lot of people are saying that it was a one-time thing, it was just one of those things where the risk department over at SVB didn't really take into consideration how fast the Fed was going to raise rates, and the way they put the money and allocated it kind of got out of whack. And that's really what caused this entire thing. Then the whole other conversation came in about FDI insurance and should it be different for businesses and whatnot. Look, even if you believe the next Fed announcement, they are only going to raise by 25 basis points again, and then maybe even further after that, which we got the Fed minutes coming up on Wednesday. That's a big thing. Keep that in mind as well, along with the CPI data. We're going to take a look at that in a minute. Even if you believe the Fed has stopped an aggressive pace, where maybe even after the next announcement, and this is just my opinion, even after the next amount, let's say they stop. Let's say they stop, not cut, but let's say they stop. There is still widely accepted right now that there is going to be a credit crunch because of what happened. And that's not good. Very similar to what we're seeing in Tesla right now. Tesla stock announced deliveries, and one of the biggest things that they announced, and again, my entrepreneurial brain popped in there where they're cutting prices. Cutting prices means margins are going down, and you can see Tesla stock actually coming down with that. That is not what the market wants to hear. So if we now start to bring that over to some of the bank stocks, and let's actually just make sure that we have a big list here. Let's see. Yeah, I agree 100%. I don't believe that there's any doubt that they're going to raise at the next meeting. I believe Jay Martin. What we're talking about is what they plan to do after that, and obviously the Fed minutes coming out. Thank you for that. I appreciate that. So again, you want to have a big list of the banks that are coming out this week. And we're going to talk about United Health in a minute, as well as a lot of the other healthcare stocks. And we're all going to break it all the way down also into a healthcare group that we're watching. So again, you need to know JP Morgan, Citigroup, PNC, and obviously FRC. Now, out of this list of stocks, and again, I'm just telling you what I personally are looking at. To me personally, I believe that JP Morgan has the best balance sheet right now, and they're going to be able to withstand most of this. Now, you can actually see where we are. Let's actually zoom out a little bit now on JP Morgan. Obviously, this 143 level is monstrous. And then after that, we kind of have up in this area around 167. Now, similar to what we're hearing in a lot of the technology stocks right now, with all of the questions about the potential recession and how this is kind of a delayed effect, there's two main arguments on the table right now. Is the recession inevitable, or the rally that we're currently having in the stock market discounting the fact that the worst is out of the way and we're kind of heading back towards the upside? It's a really big argument on both sides. I want to kind of break that down as far as the market. Now, I just want to, again, the stocks that are scheduled to report, that are the banks, obviously FRC end of the week. So again, lower prices do not mean a high probability trade. They've been consolidating for a while. So you got JP Morgan, Wells Fargo, Citigroup, and FRC. Those are the main ones. You can actually throw a couple of other ones in there. We'll just put them on the board here for you just so you can see them again, which was PNC and Wells Fargo. Okay. Out of all of those, personally, I'm mostly going to be looking to trade JP Morgan. Just from a history perspective, that's the one that I've been trading the most. I want to now work over into the economic calendar for the week. And I want to kind of bring this out. And we're going to actually take a look at ones that have the largest potential impact. So obviously we work our way through Wednesday, and the CPI data is a big deal. So you got 8:30 in the morning prior to the market opening. And you also have the Fed minutes coming out on Wednesday afternoon. Obviously jobless claims and PPI are important. But right now, for me personally, from a volatility perspective, we're actually looking at CPI and FOMC. So what does that mean? What does that mean for my trading game plan for heading into this week of April 10th? Well, the way I'm lining things up right now, and I'm going to really give you a visual of this using the S&P 500 and the broader picture of what the S&P 500 did last week. So we're going to take a look at the visual. We're going to talk about where we ended last week and how that's going to translate into my expectation and my position sizing for this week. Again, professional trading requires that you map this out, so none of it's an emotional decision after the market opens. Doesn't matter if you're day trading or swing trading. The better handle you have on here's what I expect to happen, here's how I plan to trade it, it becomes easier to make adjustments if necessary. You might get a little more aggressive if things unfold perfectly. You might pull back your position size a little bit if it doesn't. So just as a little bit of a heads up, I'm planning to trade both sides of the market a little bit more aggressively because we have trades actually on both sides. I'm going to show you what I mean by that right now as we dive a little bit deeper into the map of the S&P 500. So you can actually see this is the last week. So what's kind of blatant right now is the larger group of stocks that kind of carried the market higher, which has been the semiconductor stocks, and specifically AMD and NVIDIA. These two have been the ones that we've been actively trading the most. Now, the bigger picture that we're looking at here as we kind of dive into the semis here is how much profit potential is left after they've already rallied as much as they have. Because remember, we're putting up money with the expectation that we're tracking, stacking, and following the smart money, the stocks that have institutional attention. It's our job to spot that, which again is going to tie us back into the Chevron trade that we're going to talk about in just a minute, which is the swing trade that I'm looking for. And again, if you want to follow with all of this with me, click the link in the description and you'll be able to get a full copy of today's Daily Ticker newsletter, which is what I do for the community every single day. And by the way, if you want to trade together, our next boot camp actually starts today. You can learn about that in the link below as well. It's 14 days. You get everything. You get the course, you get my stock picks, you get the community, everything. Click down below. And if you want to learn more about that, you can click down there as well. Bill Thomas, good morning, pal. One of our international members of our community. Good morning, Bill. Always good to see you. Hope you're doing well. So again, let's get back into the sector rotation and how we're going to set things up for the week. So semis have kind of cooled off. And the area that we're focusing on right now the most are healthcare and energy. Now, there's certain pockets of energy. And I think what I'm going to do, I'm actually going to fast forward all the way down over here into the swing alerts. But before we do that, I just want to remind you, here's the scheduled earnings for coming into the week, right? Obviously, the week of April 10th, it's put out there by Seeking Alpha. We copied that. We have a breakdown this week of our new podcast episode, which is the entire week and how we're breaking the sectors down. But I want to kind of fast forward over here to the swing trade. And this swing trade in Chevron, CVX, there's two setups that I really like today in energy. One of them has pulled back and filled the gap. The other one has pushed up and paused and not moved. Believe it or not, the one that has pulled back, and this is kind of going back to what we just said before, the one that has pulled back and is at an obvious support level where I would expect buyers to step back up is okay. But we never want to settle for okay when we're putting money out there. We want to put our money into the ones that have the greatest reward potential and, just as important, the greatest likelihood of achieving that reward. Remember, just a setup is not enough. Just noticing your risk, that's not enough. The whole reason we choose to accept risk is because there's a likelihood, a probability, our edge is telling us there's a good chance we're going to hit our initial profit target. And again, something I want to keep training everybody with, teaching, there's initial profit target, which is the initial risk we take for the likely profit. So again, everybody knows risk reward. So we have a minimum risk reward setting it up. But I want to be clear about this. That's not the total risk that we're going after. After, hopefully, when we hit our initial profit target, which is the target that we hit to justify the risk, then it's imperative that we shift over to a way to manage bigger profits when that trade, if that trade is still working out. And obviously, in our universe, we call that the profit maximizer. So there's three parts to every trade. There's stacking the order flow, which is it obvious and how long has it been obvious? And I'm going to show you what I mean by that in just a second. The second part is tape reading. Tape reading is putting this whole argument together with, number one, is order flow still valid? So is it obvious? Sure. There could be a lot of stocks that are flying to the upside. And I'll give you an example right now, such as this guy right here. And let me actually go out to the daily chart. You can see what we're doing here. But can you say, is that obvious? Clearly, right? And this kind of getting us back into the healthcare sector, right? Clearly, that's obvious. But is it a good trade today? That's the question. Is you're about to hit that buy button. Is it a good idea right now? We got this massive wall, this head and shoulders top over here, and we're way beyond the optimal entry at this particular moment. So obvious and still valid for a good trade near the optimal entry is not the same thing. So I guess we can all kind of admit right now there's been plenty of trades probably early in our career where it was super obvious you couldn't wait to get involved. As soon as you bought it, maybe it moved one more day in your favor, but then it ends up pulling back. The risk reward resets. You act like a disciplined trader. You get out of the trade because you're supposed to on that pullback if it doesn't follow through. And then it ends up doing exactly what you thought. That's exactly what we're talking about. We're talking about that push and the pause. We're talking about resetting the risk reward for the optimal entry to hit the initial profit target. And hopefully then you shift into what we call profit maximizer mode. So again, there's three things that we teach: order flow stacking, which is really the main part of that. How long has it been going on? Tape reading, is it still valid? And putting that argument together for market, sector, industry group, and market internals. And then the last part, again, is profit maximizer. That's the three things: order flow, tape reading, and profit maximizer. It's really, is it obvious? Is it still valid? And is there profit potential? Those are the three questions. Simple as pie. Maybe it'll take you a couple of days to understand that. And then we get more trading together in different market conditions. So now we're going to tie that back into the trades that we're looking at this week in energy. So I'm going to now go from the swing trade into sector rotation. Okay. And I'm going to actually make this a little bit bigger. And we kind of just talked about technology. We just mentioned healthcare. I want to kind of zoom down over here into energy stocks. Okay. Energy stocks are waiting for the green light. And essentially what we're talking about is this big bullish gap last week coming off of the OPEC news. You can actually see now we're pausing for a few days right in front of 82. So if you have not done it yet, and whatever trading software you're using right now, it's important to have an alert set for crude oil at 82. If crude oil, which has now held the bid, so I just want to give you a visualization of what that means as well. When a stock moves and goes sideways, as opposed to moving up and pulling back, holding the bid means it went up and pushed sideways. That basically means that buyers are holding the bid and not letting it go down. And that's very constructive price action, especially if that price action happens on lower volume. So remember, continuation price action is when you see a push up and a pause, in this case, bullish, push up and a pause on lower volume. That means that the push up, especially if the push up was on heavy volume, that's buying, validating the price action with heavier volume. If you pause during that phase, that means that the smart money, the institutional attention on that stock is not doing anything different. That light volume pause is a continuation pattern in technical analysis. So we're looking for follow through. It's when you get heavy volume pauses that you should be concerned, or maybe move your trailing stop loss up if you happen to be in a position already. So I'm going to kind of tie this all back to two different trades today, and knowing what we're watching here in crude oil. Oxy, which is the one that we mentioned on this pullback here. We'll kind of break this down a little bit now. So energy stocks are waiting for the green light, but are still revving the engine. So they're still kind of holding the pause there. So hopefully something else that I'm introducing you to right now, which is really important. You need to make a distinction between a trading game plan and a tracking journal. A trading game plan, again, stacking the order flow and reading the tape. So now we're looking for ideas. Some of those ideas, when we stack the order flow and do tape reading, some of them go into a game plan, which are stocks we plan to trade today and this week because they're still near an optimal entry. A tracking journal might be stocks from the scans and the research you did, but they might be too far from the optimal entry. So they're a future valid trade, but not good risk reward at the moment. Okay, so super important. Tracking journal, trading game plan. Game plan is for now and you're setting the trade. Tracking journal is something has to happen before the next trade. And it's very important. That tracking journal is where, raise your hand if you're like, oh man, I knew about it and I missed it. That's just because you got to put together that tracking journal to be prepared and then set alerts also, like we kind of just showed you in Johnson & Johnson. Okay. All right. So kind of working our way through. Hess, EOG, and Chevron have now paused. So remember, we just talked about the push and the pause. ExxonMobil has my interest as it nears all-time highs again. If I had to pick one for Monday with the potential with the highest volatility, remember, this is different. Volatility from reward potential, not the same thing, okay? I'd go with Oxy as it perfectly pulled back to fill the gap. I'm looking for that support to hold for a new swing long. The stock has minor resistance near 68, major resistance near 78. So what am I doing there as I'm mapping this out? I'm mapping the levels that matter to trade around. Those levels, the probability and the volatility are going to set the tone for how I plan to go in and get my position. So you can actually see the resistance here and the ultimate target up here. So I just want to recap that one more time for you because it's critically, critically important. Every trade is different. Every trade's a different deal. So our job on that second part of what we do, remember, order flow stacking is the first part. Is it obvious? Is there a dominant side to that market? If we get back and answer, the next question is it still valid right now? Right? That's a very important thing. So as we're talking about the semiconductor stocks specifically, the move to the upside is still valid, but they've been kind of going sideways and sideways on heavier volume for the better part of 3 weeks. So right now, they are not a good trade. They're kind of stuck in a box right now. And I want to give you a visual because it's very important. A lot of members of our community like that visual representation. So if we kind of head over and we take a look at the two that we watch the most or have been trading the most, actually, NVIDIA, which you can see now is kind of stuck in a box, and we kind of draw this out and add a little bit more with volume. You can see that we've been exceeding the average volume there. AMD looks very, very similar, where AMD not only went into a box, we saw a lot of indecision with these small bodied candles, and we actually broke down through that. And you can see it's trading down lower. So we're going to keep tying this back into the trading opportunity. So Oxy, while it has perfectly pulled back after the OPEC gap and now pulled back to the gap level. So again, that is a very, very common trading strategy. When it fills the gap, that's usually the place it will stop and reverse. Or at the very least, in this case, we pushed up, pulled back, filled the gap, and you start to look for an entry. So remember we talked about just a couple of minutes ago where we said there's a difference between I can see and manage the risk versus the likelihood of it earning enough money to justify the risk. So again, we it's kind of like what you eat and whether or not you're on a diet. Sure, you could eat that cake, but is it worth it later, right? It might taste amazing. That taste volatility might be amazing, but is that actually going to help you down the line? So we tie in Chevron right now, and let's tie in Chevron with Oxy. Oxy not only is going in the wrong direction, like it pulled back just because we could manage support, we can kind of see that, right? We also have resistance here. So the upside potential is only a few dollars away. So it's got some work to do, right? If we break down the trade in Chevron that we're looking at, and this is really where we're going to tie this all together with stacking the order flow, okay? As much as I like the Oxy gap fill for a new setup, I like the profit potential for CVX Chevron over the next few weeks. So it's actually a follow-up to a trade that we put out to the community last week. So I just want to make sure that one or two sentences there did not go unnoticed. It's very, very important. I'm expecting volatility in Oxy, but I, at this particular moment, believe that there's better profit potential over the next few weeks in Chevron. There's a big difference between the two. Managing risk, volatility, and probability of profit. That last one, probability of it moving in your direction, is the most important one because that one is the one that we use to determine should we take risk at all in the first place. And I'm going to just kind of like bring this home a little bit because this is a big part of what I do in the community. I force you to think through whether or not the trade is worth it. Sure, you can identify an entry. Sure, you can identify maybe one reason into the argument to determine to put that trade on, which for most people is you can manage the risk, right? Or maybe it just popped up and you got one candle. Now, this is really where we're going to really elevate what we talk about as far as order flow stacking and what it means to put the pieces together. So order flow stacking, when I had my office in New York City, basically what it was called was the slow accumulation of millions of dollars over time. So in case you don't know the story, when I had my office in New York City, we had about 300 traders with us. We had a lot of specialists and floor clerks from the New York Stock Exchange come up and trade in our office in roughly, it was right around 2007, early in 2007, when the floor of the New York Stock Exchange started to go a lot more electronic. The hybrid execution came in, and SuperDot, with the specialists being on the floor, started to get phased out because there was a lot more electronic executions. So they came up to the floor, and we were trading NASDAQ actively at that time. They were obviously coming off the floor. They kind of let us in on what was going on behind the scenes, which was slow accumulation. So essentially, we are tracking and stacking the order flow of watching buying or selling happening over hours, days, weeks, and months. So the whole point of that is the more money that institutions spend to push a stock in a certain direction, the more we can lean on that because they've committed real money. The only challenge we have is, are we near an optimal entry? So the first part of that is Is it obvious? And how long has it been obvious? Which now ties us all the way back into the Chevron trade that we're going to map out right now, because we kind of map this out as far as that argument. Okay. The stock price shows some minor resistance at 174, but then a straight up run to 188. So let's first take a look at the Chevron trade, and we're going to visually compare it to this one and talk about the profit potential. So you can actually see we've not pulled all the way back. We haven't filled the gap. And if we get up to this 174 level, there's really nothing in between 174 and 188. Now, this is the most important part that I want to get across here. Okay. If the energy sector continues to maintain the bullish tone, this trade should play out nicely. So what am I actually saying in that particular moment as well? I am saying, here's my game plan based on all of the available information right now. Here's the trade that I can see my risk. Here's my risk. Here's what I plan to do next. And we even get to the point where I'm going to show you in a second where I plan to add shares and where my initial profit target is for that initial risk. Now, the most important part, what I'm about to explain, and again, if you want to trade with me for a couple of weeks, click the link below, learn about the boot camp. I'd love to see you on the other side, is order flow stacking and how that plays into position sizing. If you enter every position with the same amount of shares all the time, you are missing a major, major part of what it takes to be successful as a trader, which is some trades are simply better. There's no other way to put it. And the trades that are kind of just starting, you start to work your way into those positions. The ones that have obvious stacked order flow over a longer time period, which again, you got to put together price action and volume over a time period. It's not just price action and not just volume. It's putting them together where they happen and how long they've been happening. Then you start to put the pieces together for how you should go into that trade with your initial position size. So this is really kind of where I want to tie this all together. And I hope this really comes home for you. But there's one thing to plan for. This is a news story, okay, that we're looking for further validation. We've only seen a few days of stacked order flow. So again, going over here, these couple of days and the bullish gap, okay? That compared to this, we have multiple weeks of stacked order flow, but too far from the optimal entry and also heading into a wall of sellers versus we just started to rally and we have this news story. So do you see how we're starting to put the argument together? So remember, order flow stacking is the first piece. The second part is tape reading. Tape reading is it still valid? And how strong of an argument can we put together for accepting risk? What is the market doing? What are the sectors doing? So you see, we're starting to say, okay, I might be okay with taking risk, but how much should I put into this deal to start? That's the big question that a lot of people don't answer. And hopefully we're learning that working here together. Okay. All right. So kind of working our way through the rest of that trade. This is a news story, which again, we're talking about the crude oil story and OPEC. We've only seen a few days of stacked order flow, which is why the next move is significant. So I'm planning to work the position as we get positive feedback from price action and volume. This is perhaps one of the best examples of order flow stacking and how that influences our initial position size. And you can actually see the whole trade breakdown over here. So again, you can click the link below and get the entire edition of today's Daily Ticker, as well as the podcast that we put out yesterday. It's roughly 30 minutes. It will give you a much more detailed breakdown of everything that we're talking about here today and how we broke down the market, the sectors, the groups, and how we ultimately came to the trade idea that we're looking at today. So very, very important to understand that rotation happens all the time. We've had a lot of people reach out to us who want to come into our community, and they're saying that from what they're looking at, they don't see much opportunity in the market right now, and they're quite frankly afraid. And look, I understand somebody feeling that way, but it's just not true. We've had roughly 8 months of really obvious bullish price action between last year when the industrial stocks basically went on a ripping bull market for roughly 5 months, 4 months. So just give you an example of that right now, just so we understand what we're talking about. And probably the two top stocks in that group, we're talking about Boeing and General Electric. So again, you don't need a giant list of stocks. You need to understand how to track the order flow. And as it moves, we move with it. It becomes a lot easier. We're just tracking institutional attention and following it. Then to start this year, so again, that's going all the way back to October. Then to start this year, we were doing the same exact thing in tech stocks. And you can't say you missed. I mean, even some of the biggest stocks that had that same rally to start 2023. So if you right now are personally having a hard time finding bullish plays, it just means that you need to go just one level higher of understanding what order flow stacking is, how to use order flow stacking within sector rotation. And then the last part is just optimal entry and profit maximizer. So it's order flow stacking. Where is that happening? How long has that been happening? That's step one. Is it valid? Step two. How many pieces of that argument, which we just talked about through Chevron? And then basically, where do we enter and is it worth it? Like, how do we manage profitable trades? And I just want to leave you with this because it's kind of important. I think one of the most important things in trading, obviously, everybody understands, is take your losses, take your losses, take your losses, right? And then eventually we all develop that discipline to get out of trades that aren't working, right? That's fantastic. However, managing your losses is simply losing less. You've managed the downside. If you really want to get to that point where you could maybe, a lot of members of our community want to use trading to replace their income. If that happens to be one of your goals, or maybe your main goal, maybe you just want to supplement what you're making or being prepared for retirement. Maybe you want to retire next week. Who knows, right? The only way to get to that point, after you learn that discipline and that flawless execution on losing trades, you then need to have a system similar to that for profitable trades. If you want to get to the other side where you start to see your account growing consistently, it's stacking the order flow, sector rotation, and understanding how to manage and hold winning trades in better conditions. That's the last part that a lot of people miss. Raise your hand if you've gotten out of a good trade too soon and it kind of like a punch in the stomach and you're like, I had it and I let it go. That just means that last part, what we call the profit maximizer, is what you need to learn. So there's a ton of stuff going on in the market this week. I just want to give you one more breakdown of what's going on in the and how to take advantage of the newsletter today. So if you don't know, if you haven't seen it, we're starting out with the podcast. You can click here and listen and download the podcast. Then we break it down a little bit further into how the sectors have traded. So remember, I'm doing this for you every day. It will take you maybe 15 minutes to go over everything. I'm walking you through sector rotation from day to day and week to week. So you can obviously see the last 4 weeks here. So again, this is something else. You haven't been able to find ideas. There's been plenty of money that's been obvious if you understand how to track it. Then we break it down a little bit deeper into sector rotation, work our way all the way down into industry groups, and then work our way all the way down into swing trade ideas. So this is what I do for everybody every day. We're getting a little sample of it here on Monday. My biggest goal, my biggest mission with these YouTube videos is to educate you and maybe just lift you up a little bit higher to something that you're not aware of right now. Maybe it's right in front of you, but you just don't know how to see it. Maybe you see it, but you don't know how to engage with it. Maybe you want to engage with it, but you're not sure what is the right risk at that particular moment. We just talked about working into some positions. There's some ideas, like technology has been, for the most part, up to the last couple of, let's say when April started, maybe even before April, where you could go in with a little bit more aggressive position size because it was obvious and it was valid and it was easy to find optimal entries. We had some really nice trades this year so far in Meta, CRWD, CRM, obviously NVIDIA, and AMD as well. So if you need that little bit of extra knowledge, for lack of a better way of putting it, something you can have with you for the rest of your life, this is the way we do things. And again, I do this for our community every single day. It's just a question of what's available that day. That's really what we're looking for. We're looking to see what's available in the market today and this week, and then we just kind of map it out. So click the link below the description. You can download your, let me show you how to do that, actually. I think that's a big thing. Let me show you actually how to get in there and download it. Let me hide this right now. So you go up right here in the top left-hand corner and you click File. You can either make a copy for yourself or you can click over here and download it. You can see the various ways to download a copy for you. So make sure you go through this, take a look at everything in the newsletter, listen to today's podcast. We have podcasts coming out pretty much every day right now. And then again, obviously, click the link in the description or in the newsletter. If you want to trade together, I'd love to see you in the boot camp. It actually starts today, so I'd love to see you on the other side. All right. Thanks so much for joining. We got a ton of volatility this week. Have an awesome day, everybody. I'll speak to you soon.